Good morning, everybody, and welcome back to the YouTube coaching channel we call Trader Talks. Our next topic is trading a smaller account, and I'm your host, Kevin Horner. I'm stepping in for our friend Barb Armstrong today. You know, the market obviously a little bit volatile of late. We're going to do a very brief review of what we covered this morning just to see if any of the levels we talked about from an intraday standpoint hold for us this morning. We're going to do that as we look at the S&P 500, the NASDAQ 100, the Russell 2000. And then we are going to look at a static watch list of individual equities that I've been building in multiple classes over the last few months here that could offer us opportunities. So now today, interestingly, I've had some struggles with my scan tool in the Thinkorswim desktop application. I'm not sure if you guys are experiencing something similar, but in doing this, my pre-work, I noted that not only was I unable to get the scan tool to work for me, but my dynamic watch lists were not giving me results either. And so I was forced to look at some of my static watch lists, look for opportunities and ideas, and that's what we've got for us today. So with that, let me remind you, we're joined by Cameron May in the chat today. Cam will get to stuff that I'm unable to there as it relates to our conversation, but I'm going to keep an eye on things because your conversational topics will be helpful for us in today's discussion. So follow me and Cam on X if you're not already doing so. Cameron May CS, Kevin Horner CS. The best way to find us on is on X when we are not hosting classes for you here. Now, let's get to our disclosure detail, and then we can jump into our conversational topics this morning. So please remember that everything we discuss for you today should be considered informational and educational only. We do not make any recommendations here. We do not endorse a specific approach to trading the market. It's important, additionally, to know that options carry a high level of risk. These are not suitable for all investors. Certain requirements in order to trade options at Schwab must be met. Remember to go through your requisite steps to that extent. We can help you out on the phones 24/7. Never hesitate to reach out for that type of a conversation. Now, we work in a paper money version of the Thinkorswim desktop application. And why is that pertinent? Well, as it relates to trading, at least, especially with regard to options, we will not experience any early assignment in a paper money version of Thinkorswim. What does that mean? Well, whenever you sell options, you as an opening transaction, you are at risk for being responsible for either buying or selling shares of stock. That is known as assignment, and that can happen at any time when you are short an option, regardless of whether your contract is in the money or not. So the fact is that'll never happen in the Thinkorswim desktop paper money version, though. You will never be assigned early. Assignment would only happen at the conclusion of expiration of your contract, but you need to know that it can absolutely happen at any time once you are short. And yes, there are mitigating reasons you would maybe be assigned early versus assigned at expiration Friday, for example, but the key reminder or the key takeaway is that it can happen at any time when you are short option strategies, or option positions, I should say. So we will go through a market overview. We will place a couple of new example trades utilizing the paper money platform. Unfortunately, I don't have access to Barb's version of the platform, so I won't be managing any existing trades today. But that's what our plan will be, is to try and kick you off with some examples that could be considered helpful, perhaps, as it relates to maybe just some of the technical breakdown of some of these individual equity charts we'll be looking at. So with that, I wanted to start us off with a look at the S&P, and you know, that candle that we see here right now is not nearly as beautiful as it was not that long ago. We have a long, lengthy tail letting us know that sellers have come in, and we got the position, the S&P up over the 200-day moving average. If we were to look at one of my charts that I've been utilizing frequently, it's that relationship chart of the future symbols for the S&P, the VIX, and oil barrels. Again, these are just the symbols for futures. We're not recommending futures trading. That, of course, higher level of risk as well. But I think the reminder is, as oil goes, the inverse may go for our market. So as we have peaked intraday, day here, not that long ago, right around about an hour back. We have since pulled back as oil over here has rallied into the downtrend line. So the question becomes, are we simply getting a relief bounce in oil following the potential bullish headline this morning suggesting that there could be talks between Iran and the United States? Unfortunately, there were subsequent posts out of Iran that were stating that, hey, that is not what's going on. And so you've had a lot of back and forth. You're basically getting a he said situation, and it depends on which one you listen to as to where you might stand. But we can continue to watch the reaction of oil, the reaction of the volatility index, to maybe continue to provide some insight as to potential expectations here. So as oil rallies, yes, we have seen the S&P take a bit of a breather. And so we need to bear this in mind. And I think it's an example, an excellent example of why we traders maybe shouldn't be looking to take full position sizes given the nature of this market. It's difficult to ascertain. It's difficult to know which side to be on, and therefore position sizing, as Barb discussed last week specifically, the need to make certain that we don't overdo our positions one direction or the other. Doesn't matter if you're bullish or bearish. The bottom line is we can't put ourselves in risk beyond our comfort, because invariably the volatility is likely going to kick us out of those trades. So we got to take proper position sizes with which we have comfort. That should leave us with an opportunity to stick with those trades perhaps a little bit longer. Now, let's see to what extent this is impacting the NDX. I imagine it's going to be quite similar. As you can see, the NASDAQ is only up 1.25. We were up more than 2%, I think, at one point. And you can see, boy, that rejection came right at the same high from Thursday of last week. If we looked at that on an intra-period basis, there you go. I drew that line in during Trader Talk, and I can't believe it, but that's held so far. So if I was just to extend it, that becomes a pretty important level for us on a short-term basis, everyone. And remember, when Rachel and I were speaking this morning, then we were hoping to see R1, resistance 1 from our pivot points, that being this line here, provide support. And the fact is we are at it right now, trying to define it as support, but it's still unclear. We're in danger of getting through it to the downside and maybe filling in this gap that we created from the Friday PM close into today's open. But this is a bit of a tricky spot all of a sudden, so it's important for us to monitor, and it's going to look very similar on the SPX here, everyone. We'll go back to the SPX. Let's keep it on this 15-minute bars, and as soon as it renders for me, I imagine we're going to see something very much in line with what we saw in the NDX there. Well, maybe it's not going to give it to me. Let's see. Try and come back to it here. Hour-long bar. Nope, still wants to think. 15-minute bar wants to think. Let me see if I can do it with a 5-minute. Oh, there it is. There we go. So yeah, the difference here in the SPX is we didn't get into the gap, right? So let's see if this maintains. Okay, so the SPX difference slightly better, but essentially pulling back to what we would call supportive support levels here in the short run. And then the Russell doing something similar, but just a little outperformance as we've witnessed the 10-year yield finally take a bit of a breather. It has been a bit of a in rally mode of late, and that's been putting pressure on the small caps. Now, small caps just look like you've got a well-defined support with the 200-day moving average here. We'll see if that maintains, but any tests of the 200-day that hold would be considered validation of the 200-day moving average. It's when we start breaking and closing underneath it that we start to get a little bit less comfortable with that approach, of course. So keep all of that in mind as we consider what it is that's going to help us to make our decisions. Now, as I mentioned off the jump, because we do not have seemingly access to the scan tool at this point, and I don't want to belabor that point, we're going to work with a list that I have been building over the last few months. I've called it very simply potential bullish trends or bullish positions for consideration. So let's take a look at some of these and see if we can't build out a trade, an example trade or two from the list. And of course, we're going to find opportunity here, but try and be thoughtful about where you want to apply that opportunity. So a couple of thoughts. Number one, I'm going to start us off with a position in a look at Netflix. Now, Netflix has been under pressure for a big move of late. But when you look at what's going on here, this is following the news of them bowing out or not getting the Warner Brothers Discovery deal done. They had a gap move higher and then a throwback to the gap ledge. This could be intriguing from a standpoint of, hey, I'm a new bull, stock is off a certain percentage. In fact, let's take a look at the peak trough move. That was 44%, everybody. That is a healthy drawdown in a very large position. Now, Netflix, let's go to the weekly on this. Yeah, so that was the all-time peak. We had an incredible rally, by the way. This was the COVID bottom. Excuse me, not the COVID bottom. This was the bottom following the 22 sell-off of the broad market. So the 2022 spring, early summer bottom, we rallied 728%. Now, thought process behind that, you'll remember that we were still in the midst of figuring out who was going to stay home? Were people going to be getting back to work? Is everybody working from home? Are we keeping things kind of tight? So the stock did really, really well. And then it pulled back that 45%, maybe a little more than most traders would have comfort for. But, if you look at what it looks like on the daily chart, I think the thing that stands out for most traders here is that gap and now potential test of horizontal support at that gap level. And I think a lot of traders are going to make note of the fact that it held it with that low on Friday, and today we're trading well above it. So from a standpoint of considering trades in a smaller account, well, Netflix is not any longer, thanks to splits. The stock underwent a 10-for-1 split back in the November of last year. At $90 a share, we could probably do just fine to be buyers of small-sized positions. So as an example, a trader who wanted to only spend about $1,000 could consider maybe a 10-share position here and have an exit strategy that would take them out if we closed below the lows we've just created in here. And that would be pretty simple and pretty common. An easy way to manage risk. Now, alternatively, because we've seen an elevation in risk, we've had an opportunity perhaps to utilize, instead of this low here, the approximate 90.5 area or $90 level. Some traders might look at the 50-day moving average just beneath us. That's at 87.23 today, and that might provide a bit more of a comfortable spot for consideration. Why would that be? Well, it's only another 3 points to the downside, right? And so if you're willing to give up another 3 points, and we're only talking about a 10-share position as an example, well, then that would be another $30 of downside risk, right? Not tremendous is what I'm getting at. It would be the equivalent of less than 3% from the low we just made. And so some traders would say, yeah, if I was going to go with an equity position, I might own 10 or maybe 15 shares here, put a stop not at the gap level, but below the 50-day to increase the likelihood of my position holding, taking into consideration the volatility that the broad market is seeing. We can breakdown intra-period that would otherwise take us out of that trade if we, used a tight stop here, for example. If we wanted to be sure to incorporate the 50-day, we could also bring the average true range into the mix as well. Now, the interesting aspect of this is that the ATR right now on it is only $2.67. So that means that if we wanted to use the low of this gap level and incorporate $2.67, we would have to go below. We would not still be below the 50-day moving average. We would actually be above it somewhere in here. And so, again, traders, give yourself some mathematical consideration here. Not many traders are going to place an exiting stop order on an underlying equity share above a major moving average. They're going to want it to be slightly below that major moving average. And so rather than perhaps this low and calculating $2.67 beneath it, they might use the 50-day and bring it down $2.67. And I'll remind you, if we're trading it small, maybe only 10 shares, even if we are exiting at a price of approximately 85, we're looking at about $80 of downside risk if we were to be a buyer right here, right? 93.34, if we were executed there and we got taken out on a stop order as an example, around 85, we would lose about $8 a share. And if we only own 10 shares, well, then we're out $80. It's not a wonderful scenario, but it's an amount of loss that we should be comfortable with in the grand scheme of things, I hope. So those are important considerations if we're willing to be buyer of the underlying equity shares. Now, the alternative to that, of course, is we can absolutely increase our risk a little bit with potentially a short-term bullish option position, right? Some of you might be thinking about, what about a call spread here, a long call spread where we would potentially buy something in the neighborhood of the $90 call and try and sell something in the neighborhood of the last high, which might be around 100. So let me just, for example, snap that line real quick. I'll duplicate that. Push that up to the last peak. Yeah, it was right around 100, wasn't it? So we have the potential for maybe a $10 spread if the trader believed that we could move into and possibly through 100 to the upside. That's a potential scenario to play out. What would that look like? Well, if we're looking at 90 to 100, and we should always incorporate maybe a little more time than we expect, we'd probably want to move through a period beyond this Friday expiration and consider perhaps at least next week expiration, if not a little longer. And maybe the little longer, going out to maybe 4 weeks or so, might be even more ideal for a majority of traders just because of the uncertainty here. Harry, good question. What about a short put spread? Remember that a long call spread and a short put spread are essentially the same bullish viewpoint. You believe the stock is likely to rise, therefore we can consider selling contracts in lieu of buying contracts. Of course, this is the trader's decision, right? Given the nature of the volatility index, some traders may have more comfort being a seller of puts at this time due to the higher implied volatility and the potential to garner more juice in your premiums by being a seller. Now, one nice thing about being a buyer within these windows where elevated VIX, for example, can weigh on you is that the trader can spread it off and kind of eliminate the risk factor there. And thank you for pointing out the earnings. We should always incorporate the earnings detail and at least know when that's coming. So perhaps instead of the 25-day window, we should look at a one that may or may not incorporate the earnings window. That's going to be the trader's choice, though, right? Does the trader want to have a trade that takes advantage of or participates in the earnings window or not? In terms of our overall cost, we would Well, let's look at the difference here. Let's try something. Well, we've got the right strike. So if we believed bullishly and we wanted to give it just a little extra time and incorporate earnings, you give it more than an extra week. Remember, if the earnings are falling, what do we say, on the 16th here? Here's how it would, the day ahead of this expiration. Here's how it might look if we were thinking about a 90 to $100 spread, a long 90 and short 100. That would be a total cost, ballpark at the natural at least, $4.70 for the potential to make. Remember that we can, in a spread, a long spread, we make the difference between the strikes less our cost. So we could say $10 in strike opportunity less our $4.70 means we are risking $470 to potentially make $530. That's how that would work out. So that's how it would look if we wanted to incorporate the earnings window. But if we went back in time a week and chose not to incorporate the earnings window, our cost is going to be quite less. And as will, note, I say quite less. It's really not as much less as we had hoped, but it's less volatile, right? So here we have a natural that would be up to $4.45. We would not incorporate earnings, but our profit opportunity would essentially be the same. I mean, yeah, 565 or 55 instead of 530, right? Not a huge discrepancy in terms of our overall opportunity, but maybe less likely to actually achieve it simply because we don't have all that volatility to work with. So the question is, can the trader take into account a comfort from utilizing the current earnings window? And further, does the trader even want to hold the position through earnings? Meaning, there's nothing to suggest that we couldn't go with the 90 to 100 strike for the week that encompasses earnings and then look to sell before the earnings announcement, right? There's nothing wrong with that. In fact, one benefit of the trader considering this series, the April 17th series, is the expectation that implied volatility will continue to rise. In fact, let's take a look here. Let me eliminate ATR. Let me add in implied volatility. And I'm going to put that down below. Double click, there it is. All right. So if we look at implied volatility, we notice it's elevated, but we would expect it to elevate a little more. Look at here. The peak in implied volatility was up around, about 50 bips there when the last one reported. The one prior to that was lower, but notice the increase, the trend up into the earnings announcement. Trending up into earnings announcement. With 3 weeks to go, I guess my question to all of you is, would you expect to see implied volatility higher between now and the end of this in that window, the closer we get to expiration, the closer we get to the earnings, or would we expect to see it lower? My expectation would be to see it higher into that window. So as a result, the long side trader, the trader willing to take position a couple of weeks before, could not only benefit from upward trajectory in price movement, but also an increase to implied volatility. Does that make sense, everybody? So again, we don't need to consider, we can consider the window that incorporates the earnings date, but we don't have to hold it through the earnings date. I hope that makes sense, everybody. So let's consider putting a trade on like that, putting us into a potential example scenario here where we have the chance to clear that $100 level. So let's go with a standard long call spread incorporating the earnings window. That'll put us in for about $4.50 on the long side, right? If we were going to give it a little wiggle room, that is. All right. And so buying the long 90 call, selling the 100, but we got to make those dates different. So I'm just going to go to the drop down, change those to the April 17, and there we go. Okay, so the natural's at 465. Let's get up to 470 just to increase our chance of execution. So our example here is a $10 long call spread in Netflix through the earnings, but not necessarily holding through the earnings, right? So let's see how that plays. And I will maybe give consideration to this one as we go forward in subsequent classes. My other class that we could maybe look at this one in would be my building a stock portfolio, even though that is equity specific. If you're looking for follow-up to this one, check me out in that class on Tuesday afternoons, everybody. So here's again the breakdown. 90-100 call spread on Netflix for expiration April 17. Max profit, the difference between our cost and our spread amount, and our max loss approximates to the amount of our outlay for the trade, assuming that we would hold it and not allow us to take ownership of any shares. So the thought process on an exit strategy, I'm always happy to discuss that. If we move and we see that our position size, we buy it for 470 and it gets up to, say, 870, 900 from our 10, our max gain opportunity, a lot of traders would look to take profits of 75 per 60, 50, 60, 70% of expectation of the trade. However, one thought as it relates to management, if it moves against you, honestly, not every trader does this. And I'll point this out. Some traders, and I think Barb falls into this group, are more than fine to say, I'm going to put on a trade like this for 470, but if I give back, say, half of what I put on, well, then I'm going to go ahead and exit the trade, take a small loss, and look elsewhere. And that's fine, okay? However, other traders would simply say, well, Kev, 470, I'm not comfortable losing, so therefore I'm not going to invest 470. And they might, as somebody in this chat a moment ago says, what Jerry, it was Jerry Cardone here, why not consider a $5 spread and more contracts? Maybe the trade, Jerry, isn't with more contracts, but a $5 spread, which would give you less of an investment, right? Certainly less of an opportunity for profit in this case. But as an example, a 90-95 call spread only costs $273. And so what I'm getting at is, if your comfort is to own the spread and you can lose only $275, but you want to go with the larger position, right, the $10 spread, well, I think you have to give yourself the understanding that you might need more time for the contracts or for the spread to play out the way you want. So what my encouragement might be is to consider, even in a spread trade like this, that whatever you put on the table, that could be gone to zero, right? The reason I encourage you to think like that is that if you are willing to put the trade on, knowing that the amount of money you put on the table right up front, this $270 or $470 could go to zero, and I would be okay with it. I mean, don't get me wrong, we don't want to lose money, but we are needing to define our tolerance for risk. If your tolerance for risk is 270 and you spend 470, well, now you're really forcing your hand, right? You need the trade to go your way. If you are looking at it from a standpoint that says, well, I'm only really comfortable losing $270, I'll go with an outlay of $270. And then if I'm wrong initially, maybe the first 2, 3, 5 days in the trade, it goes against you aggressively. And you're looking at it going, well, I've given up my $270, so be it. Right? But what if the stock thereafter rallies? You can easily allow yourself the time to stick with it simply because you knew in advance the amount of money on the table was the most you could lose and you are comfortable with it. If that's not the case, then maybe we need tighter spreads. So I see what you're getting at, Gary. Could be Jerry, excuse me. It could be easier to manage a $5 spread, but I think the chart speaks to the $10 nature so cleanly, being that we've had a gap, a peak, a throwback to the gap. You know, the $10 range plays out. Doesn't mean you couldn't use 5 and be profitable, though. That could easily work out from that example side of things. I just thought that this offered interesting insights based on the gap zone, the broken down trend, the headline that led to the gap, which could easily develop from a former 45% downtrend to a potential new short-term uptrend. Okay. Hopefully that conversation around this one was kind of helpful. I wanted to highlight a couple of other things in here just from a technical basis on the charts here, everybody. I mean, Intel had seen a rally. It's been a bit volatile, but it has seemingly provided a recent floor of late. At least I would like to highlight that for you. Maybe it's not going to show it to me. What about Target? Will you give me a chart on Target? No. How about a chart on Lilly? Well, it's thinking about it, everybody. It might very well want to give me a chart, but it's certainly struggling a minute here. So we're going to let it breathe. Let me see if I can. Yeah, oil popping. VIX is heading higher. Taking a look at the broad market once more. Yep. So the S&P down now only up less than 1%. Same with the semiconductors, up less than 1%. All of those were making strong moves earlier. Hey, there we go. It looks like my charts have decided to become somewhat responsive here. We'll see if that sticks because I would love to show you. Okay, so looking at Lilly, everyone, interesting spot, right? Yeah, how many of you have heard the idea that if you are a long-term investor that you might consider doing so, adding to positions or starting positions at areas near the 200-day moving average? Well, this one's kind of stands out, doesn't it? We've retreated to the 200-day. Most notably of late, there was a pretty decent breakdown with the broad market selling us off. But notice the 200 here, you've had 4 days in a row of testing and holding that 200-day moving average. So again, a trader could certainly position themselves believing that this was an area where adding could make some sense. Now, this could easily offer traders a reason to consider maybe the $900 strike. But the 900 strike is literally at the money, or I guess 20 points in the money, given where we are. Not a huge amount in the money, given the size of the position, right? 20 points, not a lot. But this might be one way, again, for traders with a lesser value of available cash to trade in these high dollar positions. $900 positions. Yeah, if I bought 10 shares, I'm spending $9,000. It's not small amount of money. So this is where a trader can control the same size as a 100 share position if they are willing to cap their upside, right? And that's where the spread orders become pertinent. Now, as we talked about earlier with Netflix, you can see Lilly has a April 30 day there coming up. So with that in mind, you've got a window here where implied volatility is not likely to climb. That's basically between now and say April 15th or so. And then April 15th forward becomes that window when we expect IV to climb. So if a trader in this scenario, we're looking at the impact of implied volatility, now may not be the time to be a seller so much, right? Because implied volatility isn't elevated the way that a seller of options might encourage or prefer. So this might, given the nature of the IV, which we would expect a spike, right, over the coming few weeks there, trader might find an interesting opportunity for simply a relief bounce. And when I say relief bounce, ultimately all I'm suggesting is maybe the trader not consider all of a sudden a new uptrend developing, but rather a bounce that could be into short-term resistance, and that might be the ledge from which it fell most recently, and that comes in around 970. But if you were that trader, you may not need to stick with it or want it to move that much, right? So yeah, the next layer of resistance is 50 points above us, but you can trade that for a much smaller window in an example scenario here and might feel a little bit more comfortable. Let's just look at price on something like that. If the trader were considering maybe a $25 or $30 call spread as an example, let's see how that might work out. Again, consider your various time frames. Okay, we know that this one won't involve earnings, but the May 1 window would. So we've got a significant amount of implied volatility there, much less so over the coming weeks. What I'm looking at here, though, may suggest that this week, April 24, because IV is lower, might be more affordable for the trader. So giving it, instead of taking into account the earnings, going the week prior and considering something like, the 900 level for the call side, the long call side. And then if we were thinking about the 925, the short side, there you go. And so you're still controlling a 100 share position, but it's not costing you $90,000 to do it, right? It's costing us about $1,400, maybe $1,500, the midpoint in there. We'd have to let the market kind of work that over for us. I don't know, maybe, let's see, the natural's at 17, may force the market maker's hand in here, considering 15. But again, be thoughtful. 900 to 925, 25-point spread. If we were considering entrance for 15, then our max gain would be the difference, about 10 points, right? So again, the takeaway here, I think, is should I be considering a full move, right? A move that could take me to that level of resistance I defined on the chart, or would I be more comfortable with a lesser move because I'm uncertain about the bullishness here, okay? And of course, last of a note here is 1,500 too much? Am I spending too much to take advantage of that, okay? In a small account, maybe a $10,000 account, this is probably too big. And that doesn't mean you can't still participate, right? It just means maybe we don't want a 25-point spread, but rather maybe a 10-point spread. Okay. And now we're looking at the same window of time, 10 points. Maybe we're spending $7 to make only 3. But remember, we're buying in an area where we are currently, at least if you're buying the 900, your 20 points are now 17, 18 points in the money. So you're going to see that is, let's see if I've got it listed here. Let's look at delta on that. What is the 900 referencing as delta? The delta on the 900 call for that April 24 is 60 cents. That tells us two things. That tells us that the likelihood of the 900 being in the money at expiration is 60%, and we get approximately 60 cents on the dollar for every $1 move in the underlying equity Lilly. So we can expect 60 cents of range on this position. Excuse me. And if we look at the 925, 50 cents delta, 50-50 being in the money at expiration. Another key consideration for you all. So how would we like to play this one? I actually think, for Lilly, it may be perfectly appropriate to consider this $10 spread and see if we can get a quick and easy full profit trade, which would basically be moving through or maintaining 910. That's all this trade would need, by the way, is to stay above 910 between now and expiration for the trader to gain the full value of that trade. And granted, we're risking 700 to make the 300 in this scenario, but with a high delta, 60 or 61 delta. Remember, you traders, you can go a little bit, lower in the call side. If you want to increase your cost a little bit, if you're willing to increase your cost, you can play with that a little bit. Okay, so let's go with a $10. Let's keep it nice and snug, so to speak. We'll try and see if we can get this to hold for us, basically staying above 910 between now and expiration on the 24th. So this one would not take into account the earnings period on Lilly. So let's just look at that. Break even on that is basically 907, right? So that's our $700 maximum loss. And basically, if it closed on expiration at 907, then we would basically be at a break-even spot. Okay? So we'll go ahead and send that one off. Let's see if that one goes for us. I tried to pick a relative middle on the long call, short call thing, but it'll basically, there it went. We just wanted the market maker to kind of come to us on that one, everybody. So, and then I'm going to show you one more, but I'm not going to place an example on this because we're going to wrap it up. But the other one that made my list from the review point was the target position, and it might not even come to visible for us here on this one, everybody, but good. I'm going to address your question, Noodle Brains, as I wrap things up. What's the thought on going out the money instead of where the cost might be $150 to $200? You have to wait for the stock to move up. Is it harder to do? It's not just harder to do, Noodle Brains, and everyone paying attention here. It's also less likely, right? That's where the delta or the use of paying attention to delta can make sense. Remember, low delta means low probability. High delta, higher probability. So if you are buyer of an in-the-money contract, higher delta, higher cost, more likely of being in the money at expiration. Whereas if you go out the money, yes, you might have a greater chance for profit percentage-wise, but you have a less likely positive result is the best way to think about that, I think. So that's why traders, we tend, especially as in our beginning stages, lean towards out the money contracts because they are more affordable. They are cheaper. But that's what leads bullish traders to put themselves in rough spots, unfortunately. I know that I got going trading out the money calls as well. Majority of us do. Cheaper dollars, greater comfort for risk, and it looks like an excellent chance for profit. And yet, if you're ignoring delta, we put ourselves at greater risk than we should be probably considering. And so it's a possibility. It can absolutely work, Noodle Brains, but it has to be with the proper amount of risk, right? The right amount of money on the table so that you're comfortable losing money in said scenario, okay? I do think that that's a real tricky thing to do. I'll continue to encourage you to utilize paper money, but I would define it and say, all right, I'm going to place the same trades in the same stocks. One of them is going to be an out the money call spread. One of them is going to be an in the money call spread, and just watch how they act over the life of the spread. Maybe it's only a week window and it's just something for you to evaluate and monitor, but I do think you can learn an awful lot about these mechanics that are so important to us traders. Many of us, like me, need to see it in action. You need to have some semblance of risk on the table for it to really root and take hold for our brains. That would be my encouragement to all of you. Okay, we're going to wrap it up there, everybody. I know we had some struggles with lag technology, lack of scan detail for me at least. Sounds like Cam was able to get it to work, but nonetheless, I'm so glad that you all joined me today. Of course, you can expect to hear from Barb later again, in this class, but thanks for being here. Follow Cam and me on X, Cameron May, CS, Kevin Horner, CS, as Cam has greatly posted in there for us. And don't forget, subscribe to the channel here. If this discussion was in any way helpful for you, hit that thumbs up button for me. I'm going to go ahead and get some notes made. We'll review this one, put it into the archive for you, and you can rewatch later on if you'll find that to be helpful as well. And with that, I'll let you all get back to your broadcast day here on the Schwab YouTube channel. Hope you all have a great rest of your Monday. I look forward to seeing you again real soon.